played in Jacksonville for 3 months in the East Coast Hockey League, in like 1990s.
Very cool.
1997 or 8, and so anyways, I rode a lot of buses, and I saw a lot of North America and the world, a lot of the minor cities. I have a brother-in-law who's an investor, and he introduced me to investing by taking me to Berkshire Hathaway when I was about 25 years old. So I was in the middle of my hockey career, and he was a mentor of mine, and a friend and mentor of mine even while I was playing hockey. And he's like, you're not going to be able to chase pucks forever. I think you'll like this. And so, like, I think lots of investors started by going to Berkshire Hathaway and then reading books on Warren and all his letters, and so, like, I think that's a good place to understand where I'm coming from, and the concepts of margin of safety and buying things at a discount to intrinsic value. So I continued to play hockey. I had a PA and started investing and reading books and taking in anything that I could to help get better at it. Obviously didn't really know what I was doing at the start. And then I went to business school at Harvard after I finished my hockey career. In post-graduation, I asked David what for advice, and I wanted to work on the buy side. I retired when I was 30, and when in studying a lot of the great investors of the world, they come from different backgrounds. Some of them are typical investment banking or consulting, and some of them are arts majors, or we're working at chemical factories, or we're engineers, and so I believe that post-graduation, I graduated without a job, that I would get one, and that that the process would be self-selecting, and someone who thought differently and invested differently would have no issues hiring someone with no experience and not a finance background, although I had an engineering degree and a degree from HBS. So I moved to San Francisco, where my wife lived. I got married right after business school. My wife's a dentist. She lived in San Francisco. I moved there and went looking for work. My first job, at that time, I met both of my bosses. I met at the same time. For context, this is 2006. I met John Burbank at Passport, and then Jerome Simon, who ran Lone Star for years. And both of them very different backgrounds. Neither of them were bankers. Jerome got into investing by when his father passed away, and his father's estate went into bankruptcy, and he saw distressed people picking off his family, and he said, I want to be one of those guys. So he went to Stanford Business School and started working in distress. And then John was an arts major at Duke, and same thing, he started Passport with money from his credit card. And so I got a job with John. Jerome at the time was shutting his firm down. I got a job with John on his commodities team, working in the mining group. So I started in doing mining and agriculture, and then that expanded. Our basic materials and industrials group expanded while I was the second hire. There was a geologist and me at the start, and then as that grew, we expanded into other industries. But I started as a mining analyst, and that was 2006. So if you think of 2007 at Passport, China was going gangbusters. We were long commodities and made a ton of money, and John was also had CDS protection, was short subprime. So the firm changed, and when I started there, I was investment professional number 8, and there was about $500 million in the fund, and literally 18 months later, we were $5 billion and 25 investment professionals. So things grew really quickly there. And then 2008 happened, and the firm was down 50%. And then early 2009, redemption started hitting. And at that time in 2009, I'd mentioned that I met Jerome, and I become friends, and he became a mentor of mine, and we had dinner every quarter. And one of the defining moments in my career was having a dinner with him in January of 2009. He shut down Lone Star and then was relaunching. He shut down Lone Star in 2017 and then relaunched in 2007, and then relaunched in 2009. And he was sitting there all happy, like the cat that ate the canary. And I was, being a forced seller of assets that were marked down was worse than I think losing the money to me at that time, because you didn't even have a chance to be right. You didn't have a chance to be proven right. You were getting timed out, and I had this depressed look on my face, and I remember talking to Jerome across the table, and I said, "How do I beat you? Not how I feel now." And he's from Texas, so he twangs up his Texas accent when he talks to me. He's like, "Son, you need to learn how to short sell." And so I started a short selling book club at Passport. I started making started really from scratch, starting a process for finding shorts in our sectors and other sectors, and discussing the behavioral mentality around short selling. And 2009 and 2010, we had good years at that firm, and I was promoted to co-portfolio manager of the basic materials group. And after the world reflated in 2010, I mean, one of the things about specialties, verticals like basic materials like mining, there's a lot of fraud in that space. And so I wanted to start short selling, and my co-portfolio manager and boss, who was a guy named Jim Cunningham, who's a good friend, he didn't want to short sell in that fund, and then I ended up leading over that. So I left in early 2011 and went to join Jerome as an analyst. And when Jerome heard I was unhappy and wanted to short sell, he hired me. And it reminded me more of Passport when we started. There was 5 investment professionals at Lone Star. There was about 800 million in assets. I was covering, not just basic materials, but energy and cyclicals, and expanded into all cyclicals and all industrials, which was really appealing to me because at a big place like Passport, you find lots of similarities. And as we've developed our investment process at Maple Rock, a lot of things rhyme with each other in industries. Like lots of things between mining and energy and industrials and cyclicals rhyme with each other. And it's I think much better to be a generalist, because there's ways to hedge. We can talk about our process later. But the frustrating part was that we were siloed there, and it was limiting. So the combination of the short selling and being limited to only a certain cyclical spaces that our sector fund was allowed to, it caused me to leave. And then it was also the size of the fund. I'm from a small town. I've always been members of small teams, and I liked the idea of everybody knowing what everyone else is bringing. I mean, it's because you just know, like, who's good on your team, who's smart, who's working hard, as opposed to when you get larger and it becomes about measurement, politics, and one of the things about investing that appealed to me right from the start when I was 25 was the fact that it was a pure meritocracy, and the idea of a smaller firm really resonated with me. So going to work for Jerome was great. And then other things about Jerome that I didn't know when I was going there is that he's a micromanager, and he has lots of positions, and so that for some people that bothered them, but for me, I thought it was fantastic, and that I had one of the best investors of his generation micromanaging me, and I got lots of reps. So when I think of as an athlete and practicing, I got lots of practice with a teacher that, although he was very, very tough, and not, he's a very nice man, but not the nicest boss. I loved it, and I thrived there. I grew quickly. I improved quickly. And after I left, I went there in early 2011, and by mid 2014, I represented a large percentage of the fund. I turned 40, and I don't know what happens when you turn 40, but it was a combination of understanding more, and not liking having a boss, perhaps, and wanting to do more than even just cyclicals, caused me to start a fund. And I started it with a colleague at Lone Star at the time, a guy named Len Kipp, who was about 10 years my junior, very smart guy, and also Canadian. And so one of the things in regards to starting a company and contrasting what I learned from John and what I learned from Jerome from an investing standpoint, John was great at change, great at secular change. And one of the things I take away from him is change is mispriced, do the math. That's a big part of our process and part of our attempt to generate alpha at Maple Rock. And then with Jerome, it's tracking and risk management through tracking and looking for things that are hard or unknowable and massively mispriced in sizing. But with Jerome, staying small, having a small group of LPs gave him an added layer of risk management. So although he was more of a short seller than John, had tighter nets, and I learned how to short sell from Jerome. What I learned from him was that, to be successful long term, you can't have a gun to your head. And so so in starting Maple Rock, the first hire was Christy. I met her in San Francisco, and I was aware enough that one of the big differences between the two firms was the quality of LPs, and to have quality LPs that understood what you were doing, give you the time for your theses to play out, especially considering my background were in things that were never that popular. I mean, still to this day, I think my HBS classmates feel sorry for me because I'm a commodities investor and I didn't get into tech or something sexier. And it's one of the things that makes what we do so attractive is that, I'm not the smartest guy at the poker table, but I'm definitely not the dumbest guy. And I think the poker table in cyclical commodity land, there's lots of structural reasons why it's less efficient than other industries, and creates an opportunity for people that know what they're doing. But that also said is that the returns can be more volatile and can be less correlated. So you need a good LP base. And so in building the firm, I wanted things to be more like Jerome than John, and I asked Christy what I needed to do to make a company like that. And we've put things in our documents that limit growth on an annual basis, on a total basis. We have management fees that go down as assets go up. So all the incentives are aligned to have people stick with us long term, and for me to focus on compounding. And so we launched in 2015, January 1, 2015. And I think the first year was, where, if I could summarize the first year, what I learned was that this was my fund and my baby, and I had to get comfortable speaking like that. I think I'm a we guy. I'm a team. I've always been a team guy, and trying to manage a hedge fund as a team didn't work. And so, by that I mean, there were certain, what I've learned is that certain positions that I wasn't comfortable with, but I had on because other people were. They had a huge opportunity cost to me, and literally kept me up at night. And again, it was a moment with Jerome at the end of 2015 when we were talking about distressed energy bonds. I don't know if you remember the market then, but oil was cratering. OPEC started flooding the market with oil, and there was a bunch of distressed energy bonds trading at 50 cents. And I was having a discussion with Jerome about this, and he just gave me really direct feedback. He's like, you don't sound like yourself. You've had a bad first year. I want you to know I think you're failing, and you need to change. And I said, well, how do I change? And he goes, well, write down what bothers you and change it. You're the boss. And so what keeps you up at night? What bothers you? And so I made a list of things that bothered me, and I changed them. Some of them were actual positions that kept me up at night. And for a simple example is this: is we were short an Australian grocery store that was facing competition from low cost new entrants. It was a very well thoughtful, good idea, but it also had 30 days to cover short interest, and it was traded in Australia, so it literally woke me up every night at 2 a.m. I'd wake up and make sure it wasn't squeezing, and so the first thing I did was fucking cover that, and it was like it had nothing to do with it being a good bad idea. It was that it actually kept me up at night, and I wasn't comfortable with it. And so I realized that I say I a lot now, and I don't usually talk like this, but I had to make decisions that were good for me, because if I wasn't making good decisions, we were going to fail. And in that change in process and learning, in the first year, the relationship with Len, who was my co-founder, deteriorated quite quickly. And he left us in early 2016, and that was settled in late 2016 with me buying him out. And then so we've, in terms of the team, Calvin, Logan, Christy. Calvin and Logan are two investment partners. They've been with us since pre-launch. Christy's been with us. She's a partner since pre-launch. The other investment partner is a guy named Matt Kirk, who's based in San Francisco. I worked with him at Lone Star. He joined us, I think, in 2017, right, Christy? So he's been with us for close to 5 years.
And then Steve is the other partner who also joined us in 17, who's our CFO and CCO based in Toronto.
So when you look at the team now, we have 3 investment partners, two partners, Christy and our CFO, and then we have 3 junior analysts and an energy analyst. And that's a full team. It's probably the limit of what I can manage in terms of direct reports. I think it's something that I realized in 2015 as well, in terms of the process. And we have a very structured investment process, and in qualitative and quantitative screens, and we can talk through the top of our funnel and how everything works later. But what I found is that a lot of the magic sauce happens when I have my hands in the investment process. And so, similar to Jerome, when Len was the head of research, and was between me and the people actually running the numbers, that didn't work very well, because a lot of times I realized a lot of my ideas would be going down a rabbit hole and seeing something parallel or tangential, and actually pivoting and doing that, which is where especially when you're investigating things that are changing, which is one of our core investment traits. So I think over time we've refined what we do. I'd say we specialize in, I think we specialize in a few things. One of them, I think, change. And I think when governments, industries, people, CEOs, when things are changing, there tend to be massive mispricings there. I think we're very, very good at cyclicals, long and short. We have a process that's repeatable to find and analyze and size cyclicals globally. And I think that's really helped. It's really helped balance volatility and enabled us to be long something for specific reasons, and attempt to hedge out some of the macro cyclical risks that exist in our space. Because there's all kinds of things outside, when you're in cyclical space, that are outside of your control. And if you're not able to short sell, I think it just limits your ability to want to be in there, because you can be long something, a company that has a new CEO and it's going through some structural change that is analyzable, and then you can get sideswiped with the cycle. And so with our process, we're able to take some of that cyclical macro risk out of our long book by having a short book that's somewhat correlated but different.
And Dave, before we go too much into the strategy, I just want to pause a second and make sure that Trey or Holden, there's nothing on the business side or on the philosophy or on the intro that you want us to hit before we kind of pivot into investment philosophy and strategy in more detail.
Yeah, I was just wondering, roughly, number of LPs that you have and the way you set it up, that I understand is like based off of contributed capital. Like, why did you put that on yourself? Like, just in case, I'm thinking in a drawdown scenario and like everything falls apart and you're seeing opportunity, but you might have hit that contributed capital ceiling. Like, what do you do?
Dave, maybe I'll jump. Maybe I'll take this one and you can add on to it to add from your perspective.
Sure.
So I think there's 2 parts of that, Trey. The first is how we set it up in the very beginning, and then there's the why. So how we set it up and what actual constraints are in our docs is threefold. One, there was a $400 million max on day one that we took in. The why behind that, it was 2 times our budget. And so we wanted to give ourselves enough room to make sure that we could protect ourselves to the extent that we entered an environment like we did in 2015 or had a bad first year. And so that was the reason behind the 400. The second stipulation at that time was that growing no more than 200 million or 25% of firm NAV every year. That was to kind of make sure we were growing slowly, and not just the back office, but the investment team. We were able to manage the portfolio and kind of thoughtfully grew our firm over the years. We had set it up in terms of a net subscription, so we are still able to replace redemptions every year, so it doesn't constrain us against that. The second part of your question around how do we manage, well, if there's a great drawdown and opportunity set, Zave and I usually do that proactively. So if you think of 2020, for example, when we took in some additional LPs, instead of taking the max that we could take in, we actually cut it off at the first 5 and made sure that we had up to 100 million of additional capacity to the extent that Zave wanted to raise his hand and take in more capital. In a similar fashion, like right now, we're going out to replace up to 125, which is the total amount of trims that we had last year, just given performance, etc. But the actual number of what we can take in is technically 200. So we kind of bake that into our decision making as we look to reopen every few years.
And if you had a situation, Trey, from my standpoint, where let's just fast forward 2 or 3 years, and maybe our fund's a little bigger, and we're tapping out on that $1 billion net subscriptions, and then we have a drawdown, or there's something that's specifically great for us, and people want to give us more money. It's a simple vote, right? Like, so we've picked and this is why I don't think it's a risk in that scenario, is because the type of LPs that have self-selected into being our LPs, even if they couldn't add and it was a good time to add, we've always believed that if that hypothetical situation came, then people would vote, and if that was the right thing to do, they'd let us do it.
And it's done by external capital, right? So if we have 2/3 of our external capital voting to change their mind, theoretically, that's something that we could exercise.
Okay, got it.
The last question you had was number of LPs and the type of LPs. So we have about 30. I would say 25 core relationships, 30 on the whole. Some of them are a bit smaller. We've been not just careful about the type of capital we've taken in and the amount, but also the number of relationships. So we limited it to 3 in 2018, gave the rest of capacity to current partners, limited it to 5 last year, because the reality is Zave has a lot of things pulling at his attention, and we want to have real relationships with all of our partners. So once you get much more than that number, it becomes hard for him to have real relationships. And so we also manage that number on an annual basis as well.
Got it. And so you only take capital every now and then. Like, is there formulas to timing and frequency?
So the constraint in the docs allows for it once a year if we wanted to go out and take in up to that 200 million or 25%. In practice, over the past 7 years, we've done it every 2, because that's what's felt right to Zave and I. But theoretically, it could be every year if Zave wanted that.
Okay, got it. That's helpful.
And so,
I was just going to ask.
Oh, sorry. Go ahead, Holden.
Sorry, go ahead, Christy. No, I had a second question. Please, if you were going to comment any more on that, please go ahead.
No, go ahead, please.
My question was related to, before we get into strategy anymore, the time frame whenever you left Lone Star and started up Maple Rock. What conversations you had with Jerome? How did you and Len come together and get together at Lone Star? Apologies if I missed that.
Yeah, we worked together at Lone Star, and Jerome wanted me to stay. I stayed we told him in early 14, I think in February of 14, we told him that we wanted to leave and start our own fund. He let Len go, and I ended up working for Jerome for another 6 months till Labor Day, and so it was an interesting time in that. I was working for Jerome while publicly launching, and so anything I had to do for Maple Rock was after market hours. So it was a busy 6 months, and it's kind of one of those things in hindsight. I wish I took some time off, because we went right from. I moved to Toronto. My kids started school. And we had 3 months to launch. Len had been here. Len had been in Toronto for 6 months extra. Helped us get office space, hire a CFO, etc. So.
And I would add, Zave, that Jerome, we made that decision willingly with Jerome. Like, Jerome waived his non-compete. Obviously, he knew that we were building this.
Yeah.
The deal was basically Zave had to stay 6 months, transition about half the portfolio that he was responsible for, find his replacement, and that Jerome would be supportive of the move, invest capital, etc. He's still an investor today. But that's also why, if you look at our LP base, we have a very heavy presence in kind of middle America and the West Coast, because Zave's time to meetings was limited to those who could come to San Francisco and meet us in the evenings, because he was working every day.
No, this is helpful. So, I guess maybe we can move into like your, philosophy and approach, and like, building the portfolio, what you tend to look for. I imagine the portfolio moves in terms of kind of the exposure makeup, but just maybe we could talk about that part of, that's really what you're doing day to day.
Yeah.
On the investment side, it'd be good to hear about.
Yeah, I'd say when you think of building a portfolio, I really truly think it's just a bunch of individual ideas, and you put them together, and then you see what kind of risks you're exposed to after you put your best longs and best shorts together, and then are you comfortable with those risks? And so when we look at an individual idea, we ask ourselves three things: what does it look like that's worked before? How much can you potentially make or lose? And how do you know whether you're right or wrong? What is it? So the top of our funnel is, what does it look like that's worked before? We have numerous quantitative and qualitative systems and processes. For example, we have a price tracker. So we track, I don't know how many numbers of things, 15 pages of commodities and prices of anything that we can find. That leads to lots of ideas, longs and shorts, tracking how things change. We have a cyclical tracker where every industry that we can analyze and find that has a public security, we put on a cyclical tracker, and on that tracker is, where is the industry fundamentally? Is it trough, peak, or mid-cycle? And where's the valuation, trough, peak, or mid-cycle? So that helps us hone in on things that are peak on peak, potentially to short, or trough on trough, to potentially go long. And then we have a change tracker. So we track changing CFOs, CEOs, changing CEO. We have an accounting screen looking for potential shorts, CEO changes in industries we understand could potentially be sources of longs if there's a significant change happening. And so when we over time, there's a natural. It's kind of interesting when you think, if you started from scratch, how you build it versus the cadence that happens from the process that's already in place. But what ends up happening is currently we have buckets of longs and buckets of shorts that are sometimes thematic and sometimes are cross thematic. And when you put that all together, we have a competition process, which is a bit subjective. There's an expected return. There's an IRR for the investment, and then the subjective part that we discuss internally is, how close to our circle of competence is this? And all those things subjectively help determine, and liquidity would help determine sizing. And then when you put it all together, I think that's the buckets of risk that are common in our book are China risk, illiquidity risk at times. There's not much illiquid stuff in our book now. And now there's COVID risk. Like, I think over the last 18 months, when you look at some of the big drivers of change, it's been behavioral change, a business change, long and short, because of the very different types of COVID. And there's still longs that are not fully back to where they were because of people perceived behavioral changes, and for commodities and specifically energy right now, there's still 3 million barrels a day of international travel that's not happening. That if that came back really fast, we don't have enough oil for that scenario. So there's currently we have one of the buckets of risk that we have is a reopening risk, which is pretty topical because of Omni and what's perceived by us that Omni is potentially the best thing that happened to the world, with the exception of China. So again, we have a portfolio of best ideas. There's a process for each individual one, and then when we put them together, I determine whether how much of the risk cancels each other out, how much of the macro risk, and how volatile it is, and have competitions related to specific themes.
So when you look at your exposure, the ranges, I think it was like 20 to 60%.
Yeah.
Your portfolio. How does that change? Is that a conscious decision, or is that more bottom up? And how often does that flow around?
I mean, I try not to move it around. It moved in November, and I can explain November's move. But that's bottoms up. So in regards to one of the things I learned from we had a good 2016 when you had a cyclical recovery globally after a global industrial recession and a Chinese recession in 2015. 2016 was a really good year for commodities, energy, mining, etc. We had a good year, but whether that was inexperience or being the second year in business and not being a bit afraid, we had direct hedges on for our long commodity exposures that just cost us money. And that kind of process was like, okay, well, you don't, if something's at trough and the world's getting better, you don't short it, even if it is a shitty industry. And so that started with our cyclical tracker, which is a big part of our process now. But what I learned from that was that in 2020, when you're at a trough, you're not supposed to be short cyclicals. When on our cyclical tracker, every company is at the bottom of the sine wave. You're not supposed to short any of that stuff. So situations like that, our long exposure flexes up, and that's a bottoms up basis. Because you can't find any shorts and cyclicals, and you have all these attractive risk rewards on the long side. You're like, okay, I'm prepared to take this vol. This is a chance of a lifetime to be long this stuff, and I think we're kind of in the middle of that still. In November, we were in regards to Omni and COVID. We've done a real deep dive learning process into first the efficacy of vaccines in 2020. The manufacturing and rollout of vaccines. So and a lot of our process is being prepared for the event. And so, November of 2020, when Pfizer's vaccine was approved and you found out the efficacy was 90%, we were prepared for that moment by understanding the manufacturing capabilities, the distribution capabilities, and also we had a good idea that these things would work from the phase 2 studies. And so we prepared for that. When that moment comes, this is what you're going to do. And we were already in a lot of those things. We were long energy, long aerospace, etc. But that, because these things are potentially massively mispriced and it's just starting, and the questions around that you can prepare yourself, like the questions around distribution, etc. We already had prepared for that, so we stayed there, and we've had a very good run. But over time we've understood how these variants work, and one of the concerns, the Delta, if you look at last year, the Delta variant showed up, and it didn't, and 2 doses of vaccines didn't work. Cases started spiking in Israel, hospitalizations started spiking. There's real uncertainty whether we would be in this forever. And then, you got data from Israel with a booster dose that it worked and you'd be fine. And so we were comfortable with some of these long energy trades, with the caveat that if there's these variants and they come out, all the time, what variant would make you change your mind about being long some of this reopening stuff, and what would you do in that situation? And so we prepare for those situations. We have a if-and statement for things like that are unknowable, because if that's something. So on Thanksgiving morning, when that data came out, thankfully we were working, because we're in Canada and it wasn't a holiday, and we figured out that Omni was outcompeting Delta, which was the red flag for us to stop and be aware, because we had a handle on Delta and that it was going to go away, and China can handle Delta. And so then we set up a tracker for Omni in terms of looking at the province in South Africa where it started, and then by extrapolating the shape of the infection curve plus hospitalizations, you can get an idea of ultimate hospitalization rate. And so 2 weeks into this, we immediately hedged first thing you do when Omni was beating Delta is hedge all our energy, hedge all our aerospace, and that was prepared. This wasn't it was kind of like a triage, like, hey, it's like an emergency room. This is the patient's having a heart attack. This is the three things we do. So we tightened up the nets immediately until we determined that Omni wasn't. That actually one of the arms of Omni was that it was more infectious. It was obviously more infectious, but that it was also was not really that harmful, and that's what's happening now. And so this is an uber bullish situation, because it effectively is going to vaccinate the whole Western world really fast, whether you want it or not, and we're going to get back to normal quicker. The only caveat to that, and we'd be even more bullish on the world, on the cyclical part of the world and the commodity part of the world right now, would be I'm not sure if China can handle this. Their track and trace shut down different neighborhoods and cities doesn't seem to be working. They're shutting down entire cities. So I think China needs to have a come to Jesus moment and just let it rip. And until that, we're still more hedged than we are. But that's a long answer to, it's a bottoms up process. And when certain things happen, we have scenario analysis of what we would do if the bad thing happened.
Dave, that was super interesting. Would you mind sharing another scenario where you guys have gone through this sort of building these trackers and creating these different scenario evaluations and things like that outside of the COVID realm?
Yeah, I mean, I think it started with. I think this started in, it started in 2018. So if you look at 2016, you had a trough and a recovery. In 2017, the economy was cooking and we were still reflating. And then early 2018, the Chinese trade war started, and we're just sitting there like, well, what does this mean? What does this mean, and what is it going to do? And all the cyclicals peaked, and gross margins peaked, and all these stocks started going down, and it effectively caused a global destocking, and then it caused a global destocking, and then it caused basically an industrial recession. And so that's when I started to think, like, holy shit, you can have all these cyclical, like the normal rule book that you have, and then you can throw it out the window when something comes out of the blue and punches you in the face. And at that time it was just Trump starting a trade, or the U.S. starting a trade war that kind of still continues. So I would say this is the first time we've actually done it. Like that was the start of I didn't have a playbook in March of 2020, January, February, March of 2020 for a global pandemic playbook. So we have playbooks for lots of different scenarios that we haven't used. And I didn't have a global pandemic scenario, so we were running around with our chickens with their fucking heads cut off, trying to figure out what was going on. And we did okay considering how we were positioned coming into that. But so the first time really was November, where I had a playbook and we actually did something with it. So, anyways, yeah, like China invades Taiwan. There's one. That's not going to be very sudden, as you see with what Russia's doing with the Ukraine. You have to move troops first, right? So you're not going to get just that. You're going to get a kind of a warning on that one. But yeah, so we have a bunch of these scenarios. So the first and only time we've used it was with Omni. But yeah, we have it set up now. It was very helpful. Helps you think clearly, because your screens are flashing red and green and moving all over the place, and you know what you're supposed to do if you're prepared for it. I don't know if you read Bill Walsh's book. That's where I got the idea from.
Or takes care of itself. Is that
yeah.
What you're talking about? Okay.
Yeah, that's where I got the idea from for this, because he had like, oh, you're down by 10 in the fourth quarter and it's snowing. It starts snowing. What do you do? And he would have in his, I'm not sure if he had one for that, but that was what he talked about in the book, that he would have. You're in a backup quarterback. It's snowing. What's your playbook? It's like, I'm gonna run, And so he had all these if-and statements. So I read that book, in 2018, and then I was like, well, that would be really applicable for what I do, because we get punched in the face all the time with unexpected things. And so we wrote down these playbooks for different scenarios.
Okay, thanks. Yeah, that's super helpful and definitely interesting.
Yeah.
So could you talk about like energy, for example, how that fits into your portfolio? Like, kind of where are you with energy today in the book, and how is that different or similar to in the past?
Yeah, so I think since we launched, you've kind of had this, free access to capital for shale companies, and if you look at the last 6 years with oil, let's just talk about oil, not like all energy. We can talk about oil. All the supply growth globally has come from the United States, and so having an understanding of the economics of a shale well, and the rig and modeling the rig counts, and understanding the returns needed to break even, etc., gave you a range of prices for oil. Basically, 55, anything below $55 oil, shale would start to shrink, and anything above $70 oil, you'd have this ramp in capex that would cause this U.S. supply to grow above demand growth and bring it back. So you had this range that made it very difficult to have any secular view. You were just trading micro. It was an interesting space still from a micro standpoint, because you had changing well economics, and you had promoters, and so there was things to do long and short. So when we started, it was basically kind of looking for micro alpha in the space, and so we didn't really have a structural view. 2016 happened when we understood shale economics. So the first time we got net long energy in a big way was late 2015 and into early 2016, and that was because the oil price cratered below 50. And what you realized was that the U.S. would shrink, because we understood shale economics. We have models for all the different basins. The rig count, shale companies start burning cash, they drop rigs. There's severe declines in shale wells. U.S. declines. If the U.S. is declining, the rest of the world is not. Nothing's growing. So then it ends up hitting a point where the market balances itself. Oil has to go back to 55 at least to get them to drill again. So you kind of had this in 2016. You had a distress cycle where oil dropped below 50, and a bunch of bonds went well below par, and it made it easy to buy those bonds, because from a PDP standpoint, which is a liquidation value of the asset standpoint, at $55 oil, all those bonds almost to a T were worth more than par. And so a lot of times in these volatile situations, you buy the bonds first, and that happened again in 2020. But it enables you to have a when, not if, and also those bonds become mispriced, because not many distressed people understand how oil works and how to make an oil call, and the people that understand oil and oil prices don't like levered companies. So it created a situation that's really beneficial for us. So that happened in 2016, where we went 25-30 net long oil. It's pretty torquey stuff we end up usually doing. We end up doing the equity first, and in regards to you can dive into companies buying the debt, and then you can move into the equity of the more levered companies as you learn more, if you learn more in regards to where oil's going. And so we've only been net long oil twice, and both times was when it went below $50. The difference between what we're doing now and what we've done before is, and in terms of our process, where we have a path to profits, is that the first step is oil's got to go back to 55, or U.S. supply shrinks. If U.S. supply shrinks, global supply shrinks. That can't happen. 55 is the first price, and you value these assets at 55. And so we've done this twice in our firm. And when you're below 55, you don't want to be short anything, because oil has to go up to 55, so you get long. And then 2019, you got hints of what you're seeing now in the shale space, which in 2019, the shale producers were getting cut off of capital markets, and so they started to live within their means. And if you assume that the U.S. isn't going to grow and is actually going to just harvest cash, then that 55 isn't the right price. The incentive price to get offshore going or some other thing going is a higher price. And so what we learned last year, and we continue to learn this, is that the shale guys aren't growing, and there's really no answer. There's really no answer to the potential world oil shortage besides the U.S. guys growing. And the U.S. guys aren't going to grow until they trade at a fair discount rate based off of mid-cycle oil. So when we look at our oil portfolio now, if if I use $70 oil and a 10% discount rate, our portfolio of oil companies is up 100% on an NPV basis. Not the free cash flow yields are in the 20s and 30s, but on an NPV basis at $70 oil, we have up 100%. And I have a hard time finding things to compete with that. And so we have a 25% net long oil exposure in our book still.
In the physical, like the actual commodity, or
no, in equities.
Okay.
In equities, yeah.
So the way we view the equities is like they're cheap and like the oil price is high, so they're flowing cash. But it's like it might be different than in the past, because in the past the equities would rate upwards probably.
Yeah.
And so this would be as the oil price gets higher and the equities rally more, it would be where in our mind you'd want to come down on energy exposure. But this doesn't really seem to be the case now, just because the equities aren't moving as hard upward with the cash flow. So do you think it's different now? Like the game's different?
I do, yeah, because the U.S. isn't growing. So, and I think the U.S. can grow and needs to grow. And so they need to be priced, the equities need, so it's a reflexive thing. The world needs the oil. So the oil price is going to go up, so these guys start growing again. And they're not going to grow again unless they trade at a fair value, which is up a lot. And they're all holding that line. So, and it's also a function of the fact that they don't have that much acreage left. I mean, if you really want to go through the average, with the exception of Pioneer, and I think even EOG is kind of full of shit, they probably have 8, 9, 10 years of inventory. So ramping at when you're not getting priced at an NPV of, you're trading a discount to NPV, ramping production doesn't make any sense. So
what about on the equity side? I understand what you're saying on that side, the supply demand stuff, but just the investor appetite for energy exposure, like do you think that side of the game has changed too, that's making this different?
Yeah, well, no one really likes this stuff. Well, there's a bunch of things that I've noticed, even from 2 years ago, even from 2019. I don't think that there's anyone left that's any good, that has the ability to take risk. I think the people that are good and understand how to analyze these companies are in pods, but they can't take any kind of volatility risk. So what ends up happening, like we track the well performance of all the companies that we own on an individual well basis. And historically, when a company would have a big well or a shitty well, the stocks would move on no news, and then you'd go check them. Some random well stock would be up or down 10%, and then you go check the public database, like, oh, those wells are getting better, or those wells suck. And now, we do every month when the well data comes out, we go through our portfolio and we find that the wells are getting better in our companies and they're not moving, which tells me that no one's even looking at this data anymore, which makes me, it's kind of again, as long as the companies are being good stewards of capital, I don't really care, because if they buy back their own stock, this will be okay. But no one's really looking at this, which makes me excited. And then the question is, who's going to buy it? And it's like, I don't know. But this is a big problem. Like, the oil price matters for the world. This isn't even coal. I mean, we can talk about coal and other sources of energy that have had severe shortages this year. But this oil matters, and these things should trade at, I think they will trade at fair value. But I don't think there's much competition, which makes me super excited. You have a huge margin of safety, and you have a problem that needs to be solved. So I still think we're in the middle innings of this. I really do.
We would feel the same way too.
And then another thing I'd say is what we're noticing, like some of the private equity doesn't seem to be there. So you're seeing companies that we own making accretive acquisitions of small private blocks that are really, really cheap. The stocks are trading cheap and they're making accretive acquisitions. So that's something that I didn't expect to happen, and it makes me pleasantly surprised. And two of our mid-cap U.S. stocks have that dynamic going on, which is pretty cool.
For sure. What are some of the other bigger exposures, just don't like to use the word thematically speaking. But
Yeah. So on the cyclical side, oil's about 20%, 25% now. We have aerospace that's about 9%.
So that's of NAV, you're saying?
Yeah.
Okay.
Yeah.
All right. Got it.
Yeah, and then we have aerospace that's about 9%. I mean, that's pretty simple in that we own two companies. One of them's Triumph Group, which is a turnaround situation. We like the aerospace cycle because if you look at trend, we do this a lot we've done this a lot with COVID. Is you take trend GDP, so some things have gone above trend and some things have the demand shifted because of COVID, but air travel is directly correlated with GDP, and so if you take and so is oil demand, so is most all commodities demand directly correlated to GDP, and some things have gone above trend because of COVID. It's pulled forward demand. Some things have gone below trend. But if we go to 2022, 2023, when we assume at some point COVID's gone, air travel comes back, you're underfleeted. Like you'll have a shortage of planes, and so we look at a company like Spirit, which makes a fuselage for the 737 MAX. And the narrow body plane's easy to get your head around because it doesn't involve international travel. It's all domestic travel. And we know domestic travel comes back quite quickly and easily by studying China in 2020 and studying the US now. And so you're underfleeted, and you're underfleeted from a supply demand standpoint. I think that's going to be secular. And on mid-cycle earnings for Spirit, they do $9 a share of free cash flow, and the stock's trading at 45. So you have stocks that have 100% upside to mid-cycle in some normal world. So we have a chunky exposure to that.
Europe reopening is probably what, 10% safe, 9%?
So then Europe reopening, like really, Europe hotel companies and Europe shopping malls are trading at half price versus U.S. Shopping malls and hotels, which. I don't know. I mean, there's something weird about the U.S. markets versus international markets, and I think the U.S. markets are more efficient and look through faster. So we have that thematically.
Autos is probably a smaller one. That's at 4 or 5%. A lot of the other ones are probably 4 to 5% in aggregate, I would say.
Yeah, if you look at autos, I don't know if you've been following the news on used car prices, but they're at ridiculously high levels, and it's because demand for autos are high and the supply's been cut due to supply-related issues. You read about the chip issue. That issue is being solved, and the demand is there. So I think you take SAR goes back to peak, and there's auto suppliers that are trading at below mid-cycle valuation. So we think there's 50-60% upside to those companies, and that's a pretty simple. All we have to understand is the supply of chips. I think you'll hear us talk a lot. I think it's a lot of our issues, a lot of our best and biggest cyclical ideas have to do around supply constraints. Because I think it's much easier to analyze the supply of oil, the supply of planes, the supply of chips coming from Malaysia, than talking through whether GDP is going to grow 3 or 4%. Because that's really hard. But when you're like, hey, no one's bought planes for 3 years from Boeing, and we're going back to trend GDP, the fact that the fleet's they were underfleeted is not, that's really simple back of the envelope math. So a lot of our thematic stuff are supply related like that.
Okay. I know we're running up on the hour here, so we'll be mindful of your time, but this has been really, really good rundown. And I know you've interacted with members of our team, and you probably be able to tell, like, the responsibility of this part of the portfolio has changed to the public side. I know in the past your interactions have been with the private side, so apologize for any repetition that may have occurred just now. But on the public side, we kind of run this like liquid, cyclical, energy, like commodity related stuff. Just because there is some beta involved in it.
Sure.
So it's kind of been transitioned to us. So I appreciate you giving us like kind of the rundown from the beginning. This is really helpful.
You're welcome. Nice to meet you.
Yeah. So what we're gonna do, we have like what we call a stage 1 analysis kind of put together from some of the information Christy provided us. we're going to update that with some of the things today and share our notes with the team. We'll talk next week, just kind of do a dive on Maple Rock, and then kind of circle back with you about, maybe some next steps, if that's okay.
That sounds good.
That sounds good. Holden, nice to see you on video. I know we haven't connected before. Trey, good to talk to you again, and let us know how we can be helpful.
Great. It's a pleasure to meet you guys.
Thanks, guys. See ya.
Bye, guys. Have a good one.